Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Rebecca Patterson joins us with tours of duty at Bridgewater and Bessemer Trust. What was Brussels like? I've been there like 3 times, and to me it's this enigma almost.
It's really the heart of Europe, if you will, because you have all the European policymakers coming there regularly to talk about how to lead Europe as an entity forward. And then, of course, you have NATO's headquarters. And we have the big NATO summit coming up in Washington, D.C. in early July to celebrate the 75th anniversary of the treaty signing, if I'm getting the date right.
What's important here with the Trilateral Commission?
Correct.
Trilateral Commission, and you spoke there. The level of panic in Brussels, it's not World War II, and it's not the day Putin invaded Ukraine, but what was the level of panic over the elections, and particularly in France?
I wouldn't say there was panic. I wouldn't use that word to describe the tone there. I would say that there is a lot of frustration that Europe is unable to implement a lot of the things they've agreed on. And it takes a long time to get 27 countries to agree on anything. And so they've agreed on banking union, on capital markets union. And those things are so important for European GDP to accelerate. The fact that you still have all these frictions doing business between France and Germany or Italy and Portugal, it slows down business, it slows down IPOs. The capital markets union, they need to get more securitization to get a broader capital market that'll allow companies to borrow more easily and more cheaply. Until they can implement these things, it's going to be really hard for European stocks to outperform peers for a sustained period because they don't have that growth behind them. They know it. They know it. But without strong leadership, it's very hard to push the stuff through. And that takes us back to the French election. If we get to the second round of this election and we have what they call cohabitation, where you have one party in the Élysée and another party, fighting them all the time, you have paralysis in France, but you also have lack of leadership in Brussels. And that's their big worry, that they're just going to be stuck.
Where typically has that leadership for the European Union? Is it just Germany because they're the biggest economy, France because they're large as well? Where does the leadership really come from?
Yeah, I mean, historically, when you've had a strong Germany, strong France, ideally also a strong Italy, that trifecta could push stuff through. I think Europe, probably like most countries too, the most gains in policy, the most gains in integration have come at moments in time when you have a crisis. Whether that's the sovereign debt crisis of 2011, whether that's 2008, when there's something staring them in the face, an existential threat, somehow they find a way to agree and move things forward. Hopefully we don't need a crisis of that sort this time.
Immigration. It's not just in the United States on our southern border. It's obviously a huge issue for Europe. What was kind of the latest thinking?
And it's not going away, right? Yeah. When we just look at demographics in places like Africa, when we look at social unrest around the world, we're going to continue to see immigration over the coming decades. And on one hand, we should welcome it, right? Immigration in the United States is the main factor holding up our labor force, which holds up our GDP. But we need to find ways to do it responsibly where we reduce the social anxiety around it. And politicians are unable or unwilling, both sides of the Atlantic, to get that done for the moment.
I look, Rebecca Patterson, at the geopolitics, and I think you're going to tell me on a 3 or 4 year perspective, just ignore it. Good luck. I mean, it's tough right now to ignore this with the debate coming up this Thursday as well.
Yeah, well, debate in France tonight. Debate, that's our warm-up.
I didn't even know that.
Yeah.
Lisa, you didn't inform me. Mon Dieu.
Sorry.
Le débats aujourd'hui, ce soir.
But yes, Thursday is going to be one of those where I think a lot of people will be looking with their hands over their eyes and maybe a shot of something next to them at their table. It's very hard to put probabilities on geopolitical risk becoming realities that have true economic impacts. So I think most investors will watch it carefully, but not do much, if anything. And then, of course, we know if the risk reality becomes big enough, usually governments and or central banks ride to the rescue. All right, we saw that after 9/11. We've seen that in multiple areas, right? The regional bank crisis, Fed rode to the rescue. 2008-9, pandemic, government Fed rode to the rescue. And so, yes, you can get pullbacks, but do you want to play that knowing that it might not last long?
So given that background, let's just stay here in the U.S. with the U.S. Fed here. What do you think the Fed should do or will do, or because it's kind of, people are not really sure.
Yeah, I think the risk right now, as the Fed sees it, would be asymmetric. Growth may be moderating somewhat. We see that in jobless claims inching up, albeit from low levels, payroll growth slowing a little bit, but still a strong labor market. If you've got strong equity markets, so strong financial gains, strong home prices, still a resilient labor market, and retail sales slowing, but still okay, why would the Fed feel the need to rush, right? Because if they cut and the economy reaccelerates, then they have to backtrack potentially, which would kill credibility. So I think they're very happy to be patient here. I don't think there's any urgency in their eyes to start that easing cycle. The trick will be, you've got July, that's off the table. They would have signaled it. September, November, December. If they don't go in September, but they see more signs in November, of course they're independent, they're not political, but they also don't want to be perceived as political.
Right. Part of the Rebecca Patterson charm is a real understanding of history. It was beaten India in Florida, and of course at Johns Hopkins as well. I'm having trouble with the gloom cruise parallels to 1999, which Paul and I remember in Technicolor. I had the clearest memory of looking at the 700 red herrings behind my desk, going, there's not a dime of profit in any of them.
Right.
Is there a parallel, an analog to March of 2001?
Not a strong one, certainly not one that would prompt me to be getting out of equities here. I do think as we get closer to the election, as we're higher for longer on Fed funds for longer, that equity gains could be more limited from here. We've had a huge run up already, notwithstanding the couple days pullback we got. So I'm not looking to reduce equities or get out of equities in the short term, just be cognizant it might slow down. But to your point, NVIDIA, is it signaling it's another Cisco? Are we looking at 1999? The only parallel I see is retail investor involvement. So retail investors as a share of trading today is back up to highs we last saw around 1999. Does that mean we're about to crash? No, but it's another data point to keep an eye on. But the earnings behind these big tech companies is completely different this time around. So to me, that's a very important differentiator, makes me less nervous.
Too short a discussion. Rebecca Patterson, come back. Let's do an entire half hour sometime. We protect the copyright of all of our guests at Morgan Stanley. Get a weekly report from one M. Wilson, he of Michigan and Ann Arbor, where there's a paragraph that should be framed. And Mike Wilson of Morgan Stanley, you take us back to 1965. I don't remember 65 per se, but boy, do I remember the giddiness of the fancy suburb I grew up over the Nifty 50. Are we Nifty 50 right now?
Well, 65 was before the Nifty 50 mania, of course. But look, the point of this week's note was just reminding people that essentially we have a situation where the breadth is unprecedented. Really going
unprecedented
back.
Bad.
Yeah. Well, it doesn't have to be bad always, Paul.
Okay.
So that was the other part of the note was that narrow breadth doesn't always have to end in tears. It does end in tears if it's presaging a recession or some other shock. And we have plenty of candidates for that potentially that we could talk about. But it's more of a 50-50. You really don't know. What it tells you is that the market is structurally fragile. Okay, that's what I think is probably the real takeaway. And I think it's correct, right? Which is that we have this situation where we have a very unbalanced policy mix of extremely strong fiscal policy. The Fed is remaining very tight with interest rates, and they're flooding the system with liquidity to kind of keep it all moving along. So the stock market, as usual, is smart. What has it done? It's gone. It's gravitated to the stocks that can navigate this challenging environment, and it happens to be sort of a Nifty 50. We wrote about this week too. we think this is sort of a combination of late 90s and the Nifty 50 period. Now, both of those went on probably longer than people thought, and then eventually we had a hard landing. I kind of have that view too, is that we're in a late cycle environment that could last a while, right? So the market is behaving exactly the way it should be. That fragility is there, but it doesn't change unless you get a spark or a catalyst.
So in that type of market, in that type of framework, do we need the Fed to start cutting rates? Otherwise, this market really is at risk?
Well, look, I'm not of the view that the yield curve is irrelevant. So, the yield curve apologists are out there saying, well, it doesn't matter anymore because of this policy mix. I don't think that's right. I think what's happened is the yield curve's been inverted now for almost 2 years, okay?
Yep.
And it's just taking longer to have its desired effect on overall growth in the economy. Why? Because the government's spending so much money fiscally, and there are big companies that are still doing well, which is kind of keeping things moving along. And by the way, wealthy investors citizens are benefiting from the higher stock prices. So it's just taking longer. But we're now into that window where you got to believe, historically speaking, yield curve been inverted for 18 to 24 months, you're kind of reaching the limits of that. And that's why we're kind of on alert for potentially growth now, surprising to the downside. It hasn't happened in a way where the market cares yet at the index level, but that to me is the biggest risk to this apple cart getting turned over.
I look at your work, and everybody's very aware you had a caution going into this continued bull market. And with great respect to your caution, I would suggest a huge body of clients agreed with that caution. As you have shifted to a more optimistic upmarket based on growth, not inflation, do you see Morgan Stanley clients shifting to a more optimistic tone?
Well, that's been happening over the course of the last 9 months. Let's not forget, in last October, most indices were making new bear market lows. A lot of stocks were as well. And then we had this incredible pivot, not only by the Fed, but by Treasury. And that worked swimmingly to inflate asset prices. So I think, investors were forced to participate whether you were, positively inclined or not. And now, though, we're in a situation where that goodness, that soft landing, has been sort of priced, which makes it harder. It doesn't mean it has to, crash tomorrow or there's going to be some terrible outcome. But this idea that you can just sort of gravitate to Nifty 50 type world, that's played out now correctly. And so the question now you have to ask yourself is, can multiples continue to expand further when the Fed starts cutting? Our experience is that once the Fed actually starts cutting, that's probably when multiples come down, ironically. So the longer the Fed waits, the longer that this environment will probably persist.
It's almost as if the expectation of rate cuts are as valuable, maybe even more valuable, as an actual rate cut.
More valuable.
As long as, more valuable. It's kind of buy on the rumor, sell on the news type 100%. Of thing. So let's just talk about valuation here. How do you think about valuation in this market? Are you one of those folks that pulls out the Magnificent Seven and says, we're okay, or how do you think about it?
We're expensive no matter how you cut it.
Okay.
Right? When you look at median multiple, the average multiple, taking out the 7 for the 493. Now, of course, certain pockets of the market are more expensive, and correctly, right? High quality growth is expensive because that's where the earnings have been. So I don't it's not that it doesn't make sense. It's happened for a reason. First of all, my belief on valuation is very clear. It's useless in the short term. It's the most important thing in the long term. So in other words, over 12 months, valuation is irrelevant. Over 7 years, 7 to 10 years, it's perfect. It has a perfect.
That's right where I wanted to go, and because of time, I got to get this in. It's too important. Yeah. Have you moved your terminal value out to rationalize higher multiples, or are you putting more weight on individual year performance versus some fancy calculation of what's out there?
It's the latter. We have to navigate the markets in the 6 to 12
literally
months.
On a quarterly basis.
That's how people invest. Yeah. And not day to day, but that 3 to 12 months is really the sweet spot, Tom. Absolutely.
So where are you 12 months out?
We're basically flat on the S&P or slightly down because we think as earnings come through, the multiple will normalize to 19 times. By the way, 19 times is still in the top quartile.
Yeah.
Right. So we're not. Right. That was one thing we got wrong last year. Is we thought the multiple would normalize to 17 times. It didn't get that low.
30 seconds. When you read Ellen Zentner or you're in a meeting with Ellen Zentner, what are you listening for?
Well, Ellen has been, correct in this late cycle environment, and so what I'm listening to is tone change on, what she's worried about now. She's focused on labor. She put a note out Friday talking about the restaurant performance. Basically restaurants slowing, and that's one of her favorite metrics that kind of suggests that, hey, consumers are softening a bit. Not a recession, but those are that's another reason why we're we're worried more about growth disappointing than inflation surprising on the upside.
Right. Mike Wilson, thank you so much. He is with Morgan Stanley. Yeah, the way this works is you have a normal presidential debate, and like a building away or off to the side will be the media, and they're hanging out and they're wishing they were at Bar Margaux of the Four Seasons Hotel Atlanta. Except this time around, there can be no one there. So we're just assuming David Gura will give us team coverage from the Bar Margaux at the Four Seasons Hotel in Atlanta. You and I could literally have lunch over a gimlet on this.
Also at Bar Margaux.
What a strange debate. How do you, I mean, you've got experience here. How do you approach it?
It'll be strange. It harkens back to the debate in 1960, and Mark Thompson, who runs CNN now, has been very clear about that. He wants to return to the sort of Kennedy-Nixon style intimate debate on a stage without the presence of an audience. And we're going to have the moderators of the debate, Dana Bash and Jake Tapper, with the ability to mute the candidates while each other is speaking. It'll be very interesting to see how each feeds off that lack of audience, if that makes sense. We know of Donald Trump, the former president, and how he loves to speak to big crowds, how that animates him. This will be an entirely different thing to be in this studio at CNN's new old headquarters in Atlanta, in a room with just the moderators and his opponent with President Joe Biden.
Help those of us not at the speed on this, which includes me. Is this the debate of the season, or are we going to do this again?
Two are on the schedule. So CNN has this first one. ABC has one in September. It is the earliest one that we've had. So we're still weeks away from the political conventions, of course. That makes this interesting. And then for a long time in this country, we have had a debate commission, a nonpartisan group that arranges these debates, puts them on, does them without commercials. That has now become a vestige of the past. And so this is now up to CNN to determine how it unfolds, and the candidates have bought into what CNN has laid out for them.
My summary of this, and I do think it's in the zeitgeist, is this is so canned and so prepped that they're going to have a question, and it's going to be inflation, whatever the question is, and all we're going to get is talking points. Is this going to be a talking points rehearsed debate?
I think that there will be some of that, of course, and the president has been and is at Camp David outside of D.C. preparing for this. We don't really know how the former president, Donald Trump, is preparing for it, but there was a fascinating piece in the New York Times today by former Secretary of State Hillary Clinton, who has, of course, debated both of these men. She debated Biden back in 2008 during the primaries and debated Donald Trump in 2016. And she picked up on what you're talking about, Tom, and that is, you don't really know how this is going to go with Donald Trump, and it's hard to prepare for and base a debate performance on a genuine debate over the facts. I think what's yet to be seen here is how much the current president will be able to sort of ride those facts, stay on them, if there are interjections by or diversions by the former president during the course of this.
But if his mic is off, I'm lost on this. Just to pick one of them, President Trump is saying things that are not accurate according to President Biden. Can President Biden come in and say, like in the normal debate that you and I had years ago, oh no, I don't take your, like debate, Lisa, did you do 7th grade debate?
I did not. I was playing basketball.
Lincoln Douglas, Lincoln Douglas style.
You and I flunked it, and Gura got an A+ at some school in North Carolina. There's not going to be a normal back and forth.
No, we remember from the last debate between these two men that kind of shut up moment where Joe Biden interjected and told then President Trump to be quiet on stage. That can't happen this time around. So, if you're Donald Trump and I ask you a question, you've got 2 minutes to answer it. I then would have a minute to respond, and the moderator has discretion to ask either of us to respond in another minute. But you won't have that kind of extemporaneous verbal action. I do think that, if you go back to that debate between Donald Trump and Hillary Clinton, there were so many moments when, say, Donald Trump walked around the stage, stalked around the stage. We'll see sort of what kind of physical moments there are. Maybe they move away from the podium.
And folks, you got to understand how twisted Gura is. He reads 538 polling results to his children when they go to bed.
They love it. They really love it.
What portion of America for David Gura is undecided? I'm voting for Trump. I'm voting for Biden. I would suggest the group in the middle is pretty small. Am I right?
It's a very slim section of the population. I think the big question is who's going to come to the polls. I think a big thing that certainly the incumbent president worried about is who's going to show up on Election Day. I think the appeal here is to make the stakes clear to the electorate, make it important for them to go to the polls in November. But you're right, we have kind of a calcified electorate in this country. There was a lot of speculation after the guilty verdict here in New York? Would that change markedly the former president's base? We haven't yet seen that dramatically in the polls.
Smart question here on YouTube. Thank you for the live chat on YouTube. Gura doesn't have that on the big take. We have it here. Here it is, David. Will CNN have real-time fact-checking as they cut off the mic?
It is a great question. No, they will not. And we've heard the moderators and read comments from the moderators in press ahead of this debate saying, look, their job is to have facilitate as civil a conversation as they can. This will appear on CNN, Bloomberg Television, Bloomberg Radio, across many different media platforms. CNN has said they will do fact-checking immediately after this 90-minute debate concludes. But Jake Tapper, Dana Bash won't be in the moment saying, that's not true. Here's why. Here's an example one.
Sparta just emails in. He says, Tom, shut up about the debate. What are we doing on the big take? Our sterling podcast of 20 minutes every day is different.
Well, we have a great episode coming out today. I spoke with Brad Stone and about his interview that he did with Bernard Arnault, the head of LVMH.
Really cool.
And it's a rare thing to sit down with one of the richest men in the world, Brad did, and that'll come out this afternoon. And then I go to Atlanta tomorrow, so I'll be appearing on radio and television, YouTube, of course, doing a podcast from there as well. Our hope is to turn one very quickly after this debate concludes, involving our bureau in D.C. and reporters.
You can go full circle. You can shop at the Louis Vuitton store at Atlanta. You know, you could look. I saw Shaq one day on Central Park South with the $8,000 Louis Vuitton bag that Audrey Hepburn had in Charade. I could see you with that.
I was going to say, he wasn't buying a suit off the rack. No, Shaq wasn't able to do that.
No.
Yeah.
Did you hear they're going to tear down the Louis Vuitton building at 57th and 5th Avenue?
It's a tower. They're going to remake it.
They're going to tear it down.
Wow.
I think.
I haven't been in the Tiffany. I know you've been in the Tiffany store. You're taken there under duress often. I haven't been yet. I hear the one here, not this week. The line of credit still stands. I know you anyway.
That's a national line of credit. David Gura, thank you so much. On his way to Atlanta. Tom. He'll be at the Bar Margot for the debate.
I can join you from there if you want. Just give me a call.
Get a remote there, 9 p.m., 10 p.m. over the Gura Gimlet. David Gura, thank you so much. And look for the big take. Seriously, folks, some important work. Anna Raskoway and Brad Stone on LVMH and Mr. Arnault. Really, really informative chat about some of the acquisition tendencies of Mr. Arnault. Francis Donald, on this American economy, is it moving forward?
Well, it is moving forward, but what does the new forward look like? I do believe that we're at a tipping point here. So for the last year and a half, I've heard everyone use the term normalizing. Things are coming down from their peaks, but they're normalizing, and that's a good thing. And I've always thought that was a bit weird because in past cycles, we wouldn't have used the term normalizing. We would have said it's weakening off the highs. And I've been waiting for that moment when we stop using the word normalizing. And I think we're on the cusp of that, Tom, because just about every indicator now in level terms is about where it was right before COVID, which, by the way, was not actually a position of strength. And so now I'm asking myself, what comes after normal? And I think that should be the key question for everyone.
We haven't even brought this up in days, folks. I've been remiss on this. Okay, we're back to 2019. I get that. I do the same thing you do. The Bloomberg Terminal, folks, is great for this. You can get right back to where things were on whatever the series is in 2019. Except our debt and deficit and our interest expense at the federal level, Francis Donald, is not 2019. Do you care?
Oh, absolutely you care, because one of the main engines of this so-called normalization, this resilience, the economy has behaved so well, even though we've gone through one of the fastest, tightest monetary policy restrictions, was government spending. This didn't just happen in the U.S., it happened globally. But now for every $100 that the American government takes in, they have to spend $19 on interest expenses. And that's super relevant for two reasons. The first one is that it's going to restrict just how powerful fiscal can be moving forward. It doesn't even matter who wins the election. They will hit up against market limitations. But the second is, I think, the Fed has this dual mandate, price stability and full employment, but of course they're watching the interest costs that are on the federal government, because it flows through in the end to how strong this economy can be in perpetuity. So that is a huge differential. And I think what's really clutch is we differentiate between what is truly a normalization and what are the long-term structural changes that have occurred here.
Is the equity market delinked, from the U.S. economy?
Absolutely, but it always has been, Tom. I mean, for years I've been an economist and a strategist, and it's great when the jobs are the same because I don't have to work as hard, but often they end up being very separate. And you've had plenty of guests who have talked about just how this is not really as broad as it should be. But at the same time, if we're talking about how do things behave normally, I'm not actually shocked to see the equity market doing fine right now. Even though we've been nervous about the U.S. economy, we know that market can persist right up until the Fed's first rate cut, right until you see real damage in the labor market. That's just not here yet. We do think it'll come, but we still got a couple more months. So you can be really concerned about where the economy will be in 6 months and still say it's not time to pull back on risk just yet.
Yeah, Francis, in the short time we got left, I've got to go back. Folks, I went up to Toronto to see the Devils play the Maple Leafs, and Francis said, well, let's do a panel. So we did this riveting panel with Francis Donald, packed room. Thank you, Bloomberg LP, for arranging that. And Francis, I was thunderstruck by the Canadian economy, the turmoil in immigration. What lessons at Manulife have you learned in your economic study of immigration and substantial immigration, migration maybe, in Canada? What have you learned?
It's a great question, Tom, because we have a lot of American economics now focused on this increase in immigration. Well, if you want to know what that does to an economy, ask Canadian. We've had 3% population growth, some of the largest population growth that we've seen on record. And in the end, it should be supportive of your economy, but it has actually made it really, really difficult to see what's going on in the data. And that's because even though growth, the pie has become bigger, GDP has been larger, GDP per capita, the pie available to each individual Canadian, has been shrinking for 2 years. And therefore, those who look at the economy in aggregate have been able to say the economy is resilient, but actually there has been less per person going around. Yeah. We've had trouble calculating the data. We've had trouble getting a sense of the true underlying strength. It's been a big challenge for not the statistical agencies, but also the central banks. The U.S. is dealing with a small version of this. I think there's much more robust data in the United States to get a sense of it, but large-scale immigration makes an economist and therefore a central banker's job harder. There's no question about it.
Valuable. Francis Donald, thank you so much. Thank you again with David Rosenberg for that panel that we had up in Toronto. Francis Donald of Montreal and Boston. It is Manulife. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.